Mr. Chairman, shareholder Rita Mazalevskis has a question. Thank you.
Hello again. This is a legacy question. So just in regard to what you said just before, there are AFCA legacy cases ongoing at the moment, so they're relevant. In regards to customer living expenses, BOQ policy used to be to use the Henderson Poverty Index, which was the HPI as a baseline. In 2002, BOQ was subjected to the Australian Financial Regulation Authority industry-wide targeted review of serviceability. In August 2012, BOQ received its draft targeted review report, which included recommendations relating to the assessment of living expenses, interest rate buffers and credit policy enhancements in relation to assessment of living expenses in the report provided. It goes on to say that in November 2014, ASIC updated their RG 209 credit licensing responsible lending conduct to clarify that the use of benchmarks is not a replacement for inquiries about the consumer's current income and expenses or an assessment based on the consumer's verified income and expenses. Then it went on to say in March 2015 that ASIC informed BOQ of its concern that BOQ was failing to meet its obligations under S130 of the National Consumer Credit Protection Act 2009 by using HPI as a proxy figure. It says that the estimate consumer living expenses rather than asking loan applicants about their actual expenses. And in ASIC's view, this indicates that the inquiries and verification carried out by BOQ are insufficient to assess whether the loan is suitable or not. I believe that they then went on to ask what BOQ will do in relation to people that have been affected by this through hardship and defaults and other scenarios. I just want to know if you have figures of legacy cases, and did you go back and contact people that you use this HPI index for in their loans that did go through hardship and defaults that may not have been aware that the issues were not caused by them and that they shouldn't have been in the position that they were in at the time?
Chair, I can touch on that. So, Ms. Mazalevskis, thank you for your question. I mean, the starting point is that as an objective, it's all about making sure that we do responsibly lend at all times. It's not in the interest of the bank to be giving loans out to people that can't afford those loans. Obviously, at the same time, we want to make sure that we are supporting people and helping them into their homes, which builds for better families and better homes. So it is a delicate balance. The requirements as they state right now is that you do have to inquire about someone's expenses. You can use benchmarks, but it has to be both. So you've got to inquire and use a benchmark to help you out. So that's become much more clearer as the regulation has kind of settled in terms of responsible lending. We abide by all our requirements. The only other point I would make is if a customer is going into hardship, we really do encourage them to come and see us. We're all about, in a very bespoke manner, dealing with the individual customer's needs.
Yeah, but my question was more based around there are a lot of people that did go into default and hardship, not understanding why, because of the way their loan was set up. And did you go back and do a review of loans? And I can't imagine you would have, but I'd like to think that you did, and contact people that were in that position that shouldn't have failed with their loan.
The one thing, the one thing I can say is I can't specifically talk to that. If there is an issue with a regulatory requirement that is specified to the bank, then we are required to see if that impacts any customer within our base. Now, that is a principle that all banks abide by in terms of their regulatory requirements. specifically on that issue, I can't give you the data or the information, but that's generally always required by the regulator regardless.
Yeah, so in the ones where it didn't happen, because it was a long time ago when there was a lot of hanky-panky in the financial industry, even though there still is now, that went unnoticed. So if someone was to become aware now, under the legacy case issues, I just want to know whether you actually have any cases at the moment because of the HPI instead of the hen.
So what I can say is that there's in the order of about 7 legacy cases now that are with AFCA, so they're going through the normal process. And as you know, now up to a certain date, legacy cases can go to AFCA.
Okay.
Now, they're not generally related to your specific point, they're legacy cases.
Okay. I've got another quick question, if you want. Just in regards to incentive payments with the weightings, in the payment scale, for the KPIs, which are key performance indicators for people that aren't aware, it says that growth and profitability is 50% rating, risk is 20, customers is 20, and behaviours, people and one team is 20. Now, as an example that you've actually given, someone in the growth and profitability has got a 45% weighting against a 40, but they've gone under in their customer and their behaviour and people weightings to a 19 and 18. But when you're doing your KPI weighting, you add them all up. So where your employee may have failed to do the right thing by a customer, they're being rewarded because of the profit that through their direct hand for the business. So you add everything up. So it doesn't matter that you might fail as a customer under the customer or behaviours or people, as long as the growth and profitability is up, your weighting is going to go over, which is going to take you into the higher incentive rating in your scale, and they get rewarded for not doing the right thing through their behaviours, the culture, the people. So I find quite a disconnect in your scale that you've provided for your KPIs.
Thank you for your question, and what I will comment on is that's a guideline. There is the most important issue is the discretionary override in relation to those scales, and for all of our people we have a discretionary override, and if there's poor conduct or poor behaviour in relation to a customer, that will override any financial contribution in relation to their contribution to the bank.
But isn't it the overall weighting, once that's worked out, that gets reported on a so-called, say, spreadsheet through the manager up to the board or the remuneration team to approve incentives, rather than you seeing what the scales are where they may be falling out in critical areas to do with their behaviours?
So in relation to performance management, the manager will go through all of those criteria.
Yeah.
But as I said earlier, we have no tolerance for poor conduct. So if there is a poor conduct rating, it would be very surprising that that individual would be up for incentive compensation.
Okay, thank you.